Hello everyone, I'm Ingwan from AllQuant. Today I'm going to demystify a popular product out there that are very frequently sold by commercial banks. And these products are capital protected. So what this means is that your initial investor capital is protected from loss. Alright, and in the meantime, right, these products can still offer you a potential upside that is typically higher than a fixed deposit. Okay, so these capital protected products are also known as structured deposits. So in a nutshell, right, to summarize, what you get with these products is a reasonable upside without having to worry about a potential loss itself. Okay, so wouldn't that sound like fantastic, right, for most people? Now, if the banks are actually not the ones offering it, it might even sound like a scam, all right? But actually, the entire setup of such products is not that complicated. So I'm going to talk about it here in this post. And I'm going to show you conceptually how they can be done. And you will realize that you can actually also create your own capital protected portfolio or product, right, without actually going through the banks itself. Now, structured deposits comes in many different forms. So some will pay you a fixed amount of interest every year with some added potential upside of maturity. Then some may purely, right, be tied to the performance on a basket of stocks or just simply linked to a stock index, right, such as the S&P 500. And then there are also those with much more complicated payout structures, but I'm not going to delve into them here, okay? But the main thing is that all these products will come with a lock-in period. And the tenors of these lock-in periods can vary. So they can be anywhere from as short as just a few months to as long as 10 years. All right? And for this capital protection to hold, right, you have to lock your capital in for this entire tenor. Okay, and we'll talk about why shortly. But first, let us run through a simple example of a structured deposit. So I have it down here. So in this example, what we have here is what we call a 3-year S&P 500 linked structured deposit. So this is basically a structured deposit that locks you in for 3 years and then pays you your investor principal plus 50% of the gains the S&P 500 made during this period when your deposit matures. Okay, so technically on the surface, you got yourself a product that can deliver a potentially higher return than the normal fixed deposit without having the risk of loss. So your worst case, right, is when the product matures and the S&P 500 trades below the initial level set where the deposit starts. Then in this case, right, your worst scenario is that you end up not making any money over these 3 years itself. Now let's look at the possible payout scenarios to get a better idea, right? So in this first scenario here, we have an S&P 500 growing, right, and making gains over the 3 years when the deposit matures. So let's say S&P 500 gain about 30% at the end of it. So what you get back, right, at the end of this 3 years from this product is 100% of your invested capital plus half of what the S&P 500 gained during that period, which works out to be 15%. So in total, you're going to get back 115%. Okay, so that's for the first scenario. Then in this second scenario here, right, what you see is S&P 500 being flat or below, right, the initial level that you started. So that means at the end of this 3 years, you will get back 100% of your invested capital plus 0%, right, because S&P 500 did not make any gains, right, during this 3 years that you hold. And finally, in the last scenario, which is an extremely unlikely hypothetical scenario, which is the case of S&P 500 crashing all the way to nothing, to zero. Okay, in this extremely unlikely event, if the bank or the financial institution that sells you this product is still standing and around, then all right, it is possible that you can get back 100% of your invested capital. All right. So the main question here, right, is how does the banks go about creating such a product? Actually, the process is fairly simple and they just need to address two things over here. The first is your capital protection, and then the second part of it is to deliver, right, the potential upside that they promise you, right? So to illustrate to you the process, let's use a very simple theoretical example here. Again, falling back, right, on the S&P 500 structured deposit product example I gave earlier. Okay, let's say you have $100 and you're using the $100 to buy it into the S&P 500 structured deposit. Okay, so once the bank, right, receives your $100, what they're going to do is going to use the majority portion of it, say $89, to buy into a 3-year US Treasury zero coupon bonds. All right, it doesn't have to be a zero coupon bond, but it's easier for illustration down here. So what happened is that a zero coupon bond does not pay you any coupons. It is simply sold at a discount, right? So in this case, it is $89. But after 3 years, when it matures, right, the zero coupon bond will pay you the full face value of the bond, which is $100. Okay, so if you look at it, this $100 is equivalent to what you have initially invested in the first place, right? And this zero coupon bond is actually fully backed, right, by the full faith of the US government. Okay, so unlike corporate bonds, the US government bond is unlikely to default because they don't have any credit risk. They're virtually risk free. Okay, if you don't have money, well, the government can always print more money to pay you back, right? So it is virtually free of default risk. Alright, so this is how capital protection is achieved, and this is also the primary reason behind why you need to lock in your capital for the entire period in order for the capital protection to hold. Now that the banks have secured the capital protection, they are now ready to move on to tackle the potential upside. Okay, and if you notice, out of this $100, the bank have only used $89 of it, right, to go and buy the zero coupon bond. So there's still $11 remaining. Okay, and let's just assume for this very instance here that the bank is not out to make any money out of this deal. Okay, so they don't charge you any fees at all. So what they're going to do is they're going to use this $11 to go and buy an S&P 500 options that also matures in 3 years time. All right, but because options are expensive, right, so they're unlikely to be able to buy enough options to cover the entire principal, the entire 100% of the principal. Okay, so with $11, maybe they can only buy, right, enough options to cover up to 50%, right, of the principal. So that actually means that after 3 years, your options will pay you, right, 50% of the gains that S&P 500 made, if there is any gain, right? If there's no gain, the option simply just expires, okay, and you lose the entire $11 that you initially pumped in. Okay, and what you get again is the $100 of the capital protection that was kind of like guaranteed by the zero coupon bond itself. All right, so why do banks, right, like to use options for to actually generate the potential upside? That's because options, right, have the downside safety, right? You just need to pay the premium and there's no risk of you losing, right, more than the premium you paid. And secondly, options are leveraged, right? So with just $11 or 11% of the principal, right, it can actually give you exposure up to 50%, right, of your entire principal itself. So there's an embedded or built-in leverage within options itself. Then finally, options, you need minimal management. So basically you just buy and then you just leave it there, and at the end of the 3 years you just need to see how it performs, right? If there is upside, you just deliver the upside, and there is none, the option just simply expires. Now that we know how banks, right, go about creating such products, we can actually also apply the same concept and construct our own capital protected portfolios. But why would we want to do that, right, instead of going to the bank directly? It'll be so much easier, right, just to buy the bank product. Okay, but first of all, right, bank is going to charge fees. Okay, the fees will not be low, and they tend to be sometimes not that transparent with it. And the second part about it is that it is a black box, right, when you buy a product from the bank. They don't kind of decompose it into the bond as well as the options for you. So what you're going to see is just that product. All you know is what you're going to pay for, and then at the end of the day, what is your payout going to be based on, right? In between, you're not going to see anything, right? So you won't, for example, know what bond they're buying, what kind of yield the bond has. You won't know what options they're buying and how much they're paying for the options. So basically, you won't be able to assess if you're getting the best bang for the buck. And there are some distinct advantages to implementing such an approach, especially at the payout. So we're going to see some difference here. Let's run through the 3 different scenarios. And in the bank scenarios, we're using 50% of the S&P 500 returns at payout, right, as example. Now in this case, we have replaced it with our own strategy. All right, and let's say this strategy itself returns me 30%, right, over the entire principal at the end of the maturity period. So what this means is that at maturity, I'm going to get back 100% of my principal from the bonds that matures and pays me back the face value. And on top of that, I'm going to have the full 30% that is generated from the strategy itself. Okay, and not just half of it, right? So the full 30% is going to be generated and I get to keep it, right? Then in the second scenario, in the case where the strategy is actually flat or actually falls right below, Okay, but it still has some value left, right? It actually doesn't lose every single cent of it. So in this case, right, I still get something back, right? So I'll get back my invested capital of 100% from the bond plus whatever remains of this particular strategy itself. So whatever is the residual value left from what I pump into the strategy still remains, okay? And I will get them back. And in the case of the bank product where you use an option, there will be nothing left, right? Because as long as the price of the S&P 500 is flat or below where it started, the option is going to expire worthless and you get nothing back. Okay, so the only case where it will be same, right, as the S&P 500 bank product case will be when the strategy loses and crashes to zero, right? And in an unlikely scenario as well. And in that case, what you're going to get back is just your investor principal. So here's a summary, right, of the advantages of doing a DIY capital protected portfolio versus going into a bank and investing into the structured deposit. And the first one, which is an obvious one, is the potential return that you can get. So when you DIY, right, you are using your own high return strategies and not using option strategies. So the potential return, right, can actually be higher, right, if you actually deploy the right strategy itself. But for banks, as I mentioned earlier, because they use option structures, which tend to be expensive, so that will reduce significantly your upside. All right. Then the next one is about the capital protection. So with a portfolio, right, you're investing in buying directly the individual securities itself. Okay, so the bonds, right, will be under your account. So that particular bond is fully backed, right, by the respective government or agency, right? So if you purchase a US zero coupon bond, then you are backed basically by the US government. And if you purchase, let's say, SGS bonds, then you're basically fully backed, right, by the Singapore government. Right, so that capital protection will be backed by the respective agencies or entities behind it. So as long as it's a good quality and high credit rating bond, so your capital protection should be secured, right? But for a bank structured deposit, what you actually do is you just buy into a product. You're basically extending a loan to the bank. You're lending money to the bank, and then the bank go out there to invest, and then they promise you some payout structure, right, at the end of the day. So you don't get to see or directly own the underlying securities within that product itself. Essentially what you have, right, is a lender-borrower relationship with the bank. So the capital protection, right, is actually on the bank itself. So if the bank actually fails and go bankrupt, there is the possibility that you may not receive your invested capital back. All right. So now the third point about bankruptcy event, which is kind of related to the capital protection I was talking about earlier. In the case of a DIY capital protected portfolio, depending on the broker you chose. So for example, if you are with iFAST Global Markets Singapore, right, your assets are actually being held, right, in a client trust structure. So it is actually protected from bankruptcy event. So in the event that the broker actually goes bankrupt, right, your assets will still be held in the class structure and then will probably be just transferred over, right, to another functioning broker. So they'll be safe and all that, okay? And if you are with a US broker, they are also usually protected by their US insurance side, where you can be protected up to, I think, as much as $500,000 in terms of the assets that you hold, okay? But in the case of a bank, right, if it goes bankrupt, like I mentioned earlier on, your capital protection will be void. You'll just become one of the many creditors trying to lay claims, right, after the bank files for bankruptcy. And how they pay back is going to be by the usual pecking orders. So they're going to pay back the senior secured bondholder first, then followed maybe by the depositors, then go all the way down, then maybe somewhere along the line that will be you, or people who invested into the structured deposits, right? And then eventually down to the equity holders itself. All right, so you may end up losing part or even all of the money, right? Depending on the case itself. All right, then the next part is about transparency. So when you have your own portfolio, right, sitting in an account, of course, you have full transparency, right? You see what is inside the portfolio, you see on a day-to-day basis how your securities is moving and being marked to the market at all times. So you know how it is actually performing, okay? So you will be able to know, right, at any point in time, how much money you actually have. So you know how it works at the same time as well. So for the bank structured deposit, like I mentioned, right? It is a black box. You don't see anything. You buy the product, you know what you pay for, and you know after 3 years what a payout is going to be dependent on, right? But that's basically it, right? So there's no transparency when you invest into a bank structured deposit itself. Well, the next advantage is liquidity. So basically this is still your own portfolio, right? And you're in charge. So if I want to liquidate my portfolio anytime, I can do so, right, without paying any penalties. So for example, if I look at the portfolio and it is already making me good money, I'm satisfied with that. I don't want to wait out the entire maturity period. I can liquidate now. Or if for some reason I have urgent need of the money, or maybe there's some other opportunities that I want to direct those money into, I can also liquidate, right, without any penalties. But for a bank structured deposit, it is a different case, right? You are locked in. And even if they do provide you the option to terminate, that will come with hefty penalties, and you could suffer a loss, right, from your initial investment itself. All right, so and the last point, of course, is also a natural point to follow because it is your own portfolio. Of course, you have full control over it at the end of the day, right? But with the bank structured deposit, sorry, right? It's all left to how the bank wants to run it. You have no control. Now, I've so far been talking about the advantages and the good points of a capital protected portfolio, but what are the risks? All right, so the risk is also fairly obvious. Okay, the first one is the bond that you hold defaults. Okay, because if the bond that you hold defaults, that means that your capital protection is basically gone, right? That's why it's important to invest or buy a very good quality bond with low credit risk. For example, a US treasury bond or Singapore government's issued bond, right? So these are bonds that are very, very, very unlikely to default. If they do ever default, then something else more serious is happening within the world right now, and having a capital protection being void is probably maybe not at the top of your concern list anymore, okay? So this is one of the first risks that can happen. And the second thing is that because we are running a high return strategy, naturally there will also be a higher level of risk. But having said that, the risk of losing all the money allocated to this high return strategy is still probably on the very low side. All right. So in the event that this high return strategy do ever loses all its allocated money, then you will only be left with your invested principal, which you will receive back on your maturity. So that means you will not make any money during this entire period which you hold, right, for all the way until maturity. Okay. All right, then the third point, right, is if you do need the money midway and you do liquidate the portfolio before maturity, right, then you may receive a money that's less than what you invested in. It all depends on what is the mark-to-market value of the portfolio at the point at which you liquidate, right? Because the bond value can also fluctuate up and down, right? Even though at the end when it matures, it will pay you back the full face value of $100, but in between, right, the period itself, it can go up and down according to how interest rates have been changing in the market itself. All right, and then of course there's also your active high return strategy which you're running, so that one could also run into losses at the point where you want to liquidate. Okay, so these are things that you got to bear in mind. These are the risks. There are also operational challenges involved, right, with implementing such a portfolio, right? It's not as straightforward as it seems. Okay, so and the first challenge is about getting the right bond. All right, so first of all, you're going to need access to the bonds that you need, and not all brokers provide you that same level of access. All right, so you need a broker that gives you the access to the bonds you need. And even after solving that, you will need to have the required resource to be able to purchase the bonds itself. So because bonds are not like stocks where you can purchase in small sizes or even fractional shares nowadays, right? But with bonds, right, usually there is a certain size involved, and some of them requires very large transactions before the dealers on the other end will take the bite. For example, if you talk about US Treasury zero coupon bonds, sometimes you need a couple of $100,000 or even $500,000 or more for the transaction to take place. Okay, so you will need a broker who is also a market maker at the same time to help you with those sizing issues itself. All right, so they may have a solution for that. Okay, then the next challenge is about high return strategy. It's not just simply a high return strategy alone. You need this strategy to be run without the use of leverage, preferably, right? Because if leverage is in place, then there is always the risk where it can lose more money than what you've allocated to it, and that will eat into your capital protection. Okay. And typically with such a high return strategy, you will need some active management involved, so that will require time, right, on your part to really closely monitor and actively run this particular strategy itself. And not everyone, right, have the time, even if they do have the strategy in place. So another thing to note is that capital protected strategies, right, only makes sense or is viable when the interest rate is high. Right, so this is kind of like advantage or benefit that is brought about by the higher interest rates environments today. And why is that the case? Because if you recall, we need to buy a bond, right? So when interest rates are high, right, that means the bond prices go lower, right? So if you can purchase the bonds at a lower price, that leaves you more room and more resource to go and pursue or invest into your high return strategy, which can generate more return for you. So when interest rates environment is low, right, then you have very little around to play with, okay? And then the returns that you'll be getting from your active strategy is not going to be high enough to justify the effort that is required to run this particular strategy itself, okay? Now, for those of you who are interested in running capital protected strategies before this high interest rates environment starts disappearing, but have no idea or no time how to do it, you can actually have a chat with an iFast Global Market Senior Investment Advisor. And to do that, you can just simply scan the QR code here or look for the link below in the description later on. Okay, for disclosure, AllQuant, we are not a financial advisor, we are also not a fund manager. But we work very closely with the iFast advisor, and we do get introducing fees if you engage his services. Alright, so that is all I have for today. Thank you for watching, and do remember to click on the like and subscribe to our channel for more updates. See you next round.